Hello and welcome, everyone. My name's Mike Martinelli. Our firm's Martinelli Financial Services. Thank you so much for joining us today. Today, we hope to give you an update on the market following the election and also an outlook going forward. Obviously, it's a question we've been hearing across the board. And today, we're lucky enough to be joined by Strider Alas from First Trust Portfolios. Strider is a senior economist with First Trust and part of one of the best economic teams in our industry. So Strider, thank you very much for joining us.
Mike, thank you. It's wonderful to be with you.
So Strider, this year has certainly been an interesting year, not only in the markets, but of course outside the markets as well, where we've had the highs of March, the lows of March, now back to almost all-time highs again. I want to jump right into a couple comments, especially with outlook on the market here. When we look at 2020 as a whole, I want to take a step back and see, has anything changed as far as First Trust is concerned with your S&P 500 targets?
Not at all, actually. In fact, I think the way the election went, we can get into that later, I think is actually going to boost our S&P 500 targets into next year. If you go back to last December, we always put our targets out at the end of the year. And for the end of this year, we were expecting 3,650 on the S&P 500. It actually turned out to be a really good forecast. They don't always turn out that way. And we've been through a lot this year. In fact, what's tragic is a lot of people did get out back in March as things started to really decline sharply. And yet here we are year to date, we're up over 11% for the S&P 500. And with our forecast, that puts us up around 13-14% for the year if we reach it. And that's really just our end of the year forecast for this year. Next year, as earnings start to turn the corner and come back strongly from the declines that we saw early in 2020, we're expecting another very strong year for stocks as well.
Terrific, terrific. So I'll hand you over the control here so you can share a few slides with us. And as I'm doing so, have those projections changed at all due to the election?
Yeah, so I think when we take a look at our models, what really matters in our models are corporate profits, how well companies are doing, and then also interest rates. Right. And where interest rates are going. And we use interest rates as our discount in our capitalized profits model. And so what we've seen this year is rates have been cut, and we do not expect them to rise anytime soon. While on top of that, corporate profits are growing again. And so that's very bullish for stocks next year in 2021. And in fact, I'd say that our outlook will be more positive than it even was, because it looks most likely that we're going to see a split Congress here. It's not going to be a Democratic sweep. And so for that matter, chances of taxes going up in a meaningful manner, which would hurt earnings, just does not look very likely. And so we'll see higher earnings next year than expected. On top of that, with low interest rates, should bode for a pretty good year for stocks moving forward.
Terrific. So let's jump to that COVID slide you had showed me briefly before we went live here, because I thought that was a very interesting slide to take a look at. And, while you're doing it, one of the questions I know we had discussed talking about was, obviously recent news of a COVID vaccine and very positive news on a COVID vaccine has come out and really propped up markets in the last few weeks. Is that something First Trust sees as a big driver towards growth going forward?
Yeah, I think we do. I think it's really important to put COVID-19 in perspective. And if any of you have dealt with somebody who has COVID-19 or has passed away from it or has been impacted by it, I'm truly sorry. It's just a terrible thing. The reason I'm not very dressed up is I'm actually out in my parents' house in Colorado. I live in San Diego. And my 92-year-old grandfather came down with COVID, and he's in the hospital right now, and he may not make it. And so I fully understand that it is a serious deal. Has impacted us. It's impacted many other people. Third wave, and cases continue to rise. But at the same time, I think what's encouraging is that deaths are not near spiking like we're seeing cases. We're getting either better at taking care of people who have COVID-19, but one of the biggest things is that the the age category of people who are contracting COVID-19 right now has come down substantially since that first wave, which is a big reason why we're seeing a lot less deaths. As you can see in this second chart here, this looks at the share of the population in the United States versus those who have died from COVID-19 so far. And tragically, we've seen about 240,000 people in the United States pass away from this. But it's important, I think, to look at who's most at risk. And as you can see that over a third of the deaths that we've seen from COVID-19 have come from those that are over the age of 85.
Right.
In fact, if you take a look, 80% of the deaths have occurred in those that are over the age of 65 years old. And yet those over the age of 85 make up only about 2% of the population, while those over the age of 65 make up only about 16% of the population.
Right.
And so those who are getting COVID right now, a lot of it's in that younger age category, people who are either asymptomatic or who they're experiencing flu-like symptoms, they're getting through it. So yes, more and more people are getting COVID right now, but more and more people are surviving. In fact, if you look at the current survival rates of COVID-19, overall, it's about 99.97%.
Right.
And so for me, yes, it's serious. People are contracting it. It's not fun to get, no matter who you are. But chances of you dying for it, no matter what age group you are, is still very, very slim. And I think that's important to keep in perspective and not shut down the entire economy like we did early on, because I think that's where we're going to see the most dramatic change that goes on, is from that shutdown that we experienced. In fact, you think back to April here of this year and just how far things were shut down. I mean, it was incredible. We had about 95% of the population on lockdown orders in the United States, 95% of the population. And so you think about, if nobody's spending money, if nobody's open for business, that's going to have a dramatic impact on the economy. And that's why we saw the sharpest but steepest recession that we've ever experienced in the United States, with first quarter declining by about 5% at an annualized pace, second quarter 31.4% at an annualized pace. But the good news is that we've moved out of that, and we saw a massive rebound of over 33% growth at an annualized pace in the third quarter. And we expect further growth in the fourth quarter of around 5 to 10%, even with these new cases starting to pick up and some states starting to get more restrictive in terms of being able to eat indoors or restaurants being open or whatnot. I do not believe, no matter what goes on, that we're going to get back to the levels that we saw back in April. And so for that matter, the economy will continue to grow.
So even as some of these shutdowns have started to be announced, albeit, minor shutdowns compared to previously in March and April, that in the eyes of First Trust doesn't have as much of an impact going forward, because you don't see those lockdowns being as significant as last time.
Exactly. And I think a lot of things have changed too over the last 6 months. I think companies, we live in America that's just full of entrepreneurs and innovators. And I think even over the last 6 months, companies have adapted in an incredible way to this new way of life that we're currently living in. Do I think this is permanent? No, I don't. But I think we've seen massive productivity gains over this period of time too. And so you think about restaurants a year ago compared to restaurants today. Most restaurants today now, over the last 6 months, if they didn't have it before, have a very, very efficient takeout system using DoorDash or any of those Uber Eats or any of those other companies. And on top of that, many of these companies have released apps that allow you to now order food to go on them, to pick it up. It'll be ready when you get there. And so they've done that while with less staff. And so we've seen further productivity gains. So I think even if some of these states do get more and more restrictive, the rules of the game, they really changed about 6 to 8 months ago, and companies have been able to adapt to that in a meaningful way. And so I do not believe, even though it would slow down the economy, I do not believe it would send us into a double dip recession. I think it would just see a little bit slower growth than what was originally expected.
Right. You beat me to my next question there. So, in the eyes of First Trust, you don't see a double dip even with a lockdown as corporate profits continue to grow?
Yes, we don't. If anything, we'll see a little bit slower growth. And what I mean by that is, there's a good chance that fourth quarter we could have grown here around 10% at annualized pace. Uh, I think worst case, even with some more restrictions on the economy, we'll see about a 5% quarter for growth, because I do not believe that we are going to see really any indicators in any significant way turn negative. I think if anything, we'll just see them slow down somewhat. And really, the jumping off point uh, for fourth quarter growth is September. Whatever happens in September, it's off of that. So it's not really off of the last quarter, it's off of the last month in the last quarter. And everything in September relative to the third quarter as a whole was up pretty significantly. So even if everything stays flat in the fourth quarter relative to where it was in September, we'd still see about a 5% growth rate. That might be a little complicated, but all that to say that the economy is going to continue to grow in the fourth quarter, even if we move towards more restrictions moving forward.
Terrific, terrific. So let's get back to one of your other points you brought up briefly before. Assuming a Biden presidency at this point, assuming a Republican Senate, and assuming a Democratic House, which looks like it's going to be the case at this point, it seems like the market initially reacted very positively to what's going to be more gridlock in the Senate, obviously in the House as well. Is that First Trust opinion that it's going to be good for obviously policy where it's going to be harder for a Biden administration to raise taxes with a Republican Senate, so on and so forth?
Exactly. I think that is, I think what was really priced into the market, there was obviously a lot of uncertainty going into the election. And so I think really just having some certainty, no matter what it was going to be a positive. But I think really, no matter what polls you looked at or models you looked at, most everybody was thinking that we were going to see a Democratic sweep. Now, would there be a huge majority in the Senate? Probably not, but people thought there was going to be this Democratic sweep. And so to see that not only in the House did Republicans pick up seats, but that the Senate most likely is going to stay Republican as well, I think the gridlock, exactly as you said, is a massive benefit for the markets. A lot of people were fearful, and we were too, of a Green New Deal or stacking the court or any of the other pretty extreme left policies that were put forth.
Right.
And chances of any of those going forward now is very, very small with the gridlock that we have in Congress. And so I think the market looks at that. I think in a way the market was looking for a little bit of peace and quiet. I think they're happy that we have gridlock in Congress, but at the same time, a president that's probably not going to be tweeting all the time and making half the population very, very angry very frequently. There's going to be a little bit more peace and quiet in the White House, I think, and I think that's going to go a long way for the market. Companies in general, I think, are going to perform very well. I think if President Trump was reelected and we did have status quo, we had the Senate that was still Republican and a Democratic House, I think that would have been the best mix, because I think the policies that we would have seen come out of there would have been the most pro-growth. But I think with a Biden presidency, along with a split Congress, that's also going to be very pro-growth. Not as pro-growth, but still a lot more pro-growth than we would have seen with the Democratic sweep. So I think that is the reason the market likes it the most.
Right. And just to put a bow on the tax, and obviously a very, political talk, but with that being said, the big caveat for the markets as well is that corporate profits become that much harder to raise taxes on corporations, and then therefore, hopefully, corporate profits continue in a good direction. Is that, again, the thinking of First Trust? Because, corporate taxes hopefully stay the same, at least for the short term, we should be okay?
Yep, that exactly. I think not only what matters here is that taxes will probably stay the same, but we are going to see a massive rebound in corporate profits next year as well. if you look at the Biden tax plan, which if most likely would have been easily passed under a full Democratic sweep, we would have seen the highest rate go up from 37% back to 39.6. We would have seen corporate tax rates move from 21 up to 28%. He also wanted to get rid of step up in basis at death. And I think that in itself would have been detrimental to accountants. I mean, trying to figure out when somebody originally purchased an asset way back when would have been just very, very tough. And so a lot of this is off the table now. Will we see it? I think the most likely outcome is we'll actually see state and local tax deductions be raised. And that's actually something that President Trump really got away with or lowered significantly. And I think Republicans will get on board to raise those limits to some degree anyway. And really, that's a tax cut. So that's actually going to be a benefit, even though it's more of a benefit for states that have very high taxes than anybody else. But I think overall, it's still a benefit. So all this combined, I think, is still very, even if taxes do go up a little bit, I think the profits that are going to be generated next year as the economy continues to recover will far outpace anything. And on top of that, not only if taxes went up, we've got a lot of other tailwinds right now that are really propelling the economy forward. Monetary policy is really as easy as it's ever been in history. And if you look at M2 money supply, that's the money that's growing. That's the money that's actually in our economy right now. It is up at about a 40% annualized pace over the last 6 months. And to put that into perspective, that's one of the fastest growth rates we've ever seen in history. And on top of that, you look at federal spending, government spending, it's increased by trillions of dollars this year, which at some point we're going to have to pay that back.
Right.
But we're at very low interest rates right now. But all this to say, there's a lot of stimulus in the economy right now, and that is providing a massive backstop, not only to corporations, but also to the stock market and the economy.
Yeah, and that's a question we get often from clients as well, Strider, that, how healthy is the economy without the stimulus? Is the stimulus really propping everything up? Could you talk a little bit about the overall health of the economy and where we're at today?
Yeah, so I think the overall health of the economy is improving. It's getting better and better. And the way that I like to look at this is if you take a look, we call this high frequency data. And this is data that comes out on a daily or even a weekly basis. And this kind of looks at a wide range of things that are going on. And all of them have come off the bottom substantially. You can see recently some of them have slowed down from a month over month perspective or week over week perspective, but they all in general continue to grow. And I think they will continue to grow as well. And so the data continue to improve. And I think that's what's really key here. And yes, I think some of that has been from stimulus. And the reason I say that is if you look at personal income, so that's income that people are receiving, it's an aggregate number. So that includes a sum of all income that's out there. What's been different about this recession that we went through was that personal income actually never fell 1 month over this entire recession. And that's because you think about all the people that were unemployed over this period of time, they were getting unemployment insurance, not just from the state, but also from the federal government, which has never happened before. And that money from the federal government combined with the state benefits was actually more than what most people were making. In fact, more than about 75% of the people that were receiving these unemployment benefits were making before. And so they actually saw a pay increase by being unemployed. And so for that reason, personal income actually stayed elevated over this entire period of time. Now that's driven some of the spending that we've seen recently, and I think it will continue to drive it forward. Those benefits have since worn off. But when you take a look at the savings rate got up to about 40% during the crisis here. And since then, it's come down as some of that money has moved from savings to spending. But yes, I think stimulus has played a role in this, and I think it was needed. I'm not a big fan of government spending, but if you shut down an entire economy, there's a lot of people that are going to be hurting in a big way. And so I think it did play a substantial role in this recession and recovery. But I think moving forward here, what's ultimately most important, when you think about stimulus is not what drives an economy. You can't grow you can't become prosperous by spending to oblivion. What really drives an economy, what drives prosperity in an economy is that entrepreneur. It's companies, it's corporate profits, it's how well companies are doing. And these companies continue to adapt and get better and better. And what's really going to continue to lead us out of this recession are those companies. And I think that's what we've been seeing. And I think that's what we'll continue to see. And a lot of these small companies have been left behind this year. When you look at the S&P 500, they're still down significantly. And a lot of them are value companies. And I think once we do get a vaccine and more of the United States continues to open, you're going to see a lot of those companies come back in a meaningful manner pretty quickly here. And so I think as the year goes on, COVID is a point in time. It's been a long point in time, but I think as we look out over our investing time horizon moving forward here, any opportunity from weakness to buy here, I think will be you'll be handsomely rewarded for hanging on over the next 5, 10, 15 years from where we are today.
Right, absolutely. And, if you think about the lows we had in March, to sit here and say, okay, you're going to be up 11% year to date on the S&P 500 in mid-November, everybody would have jumped at that in mid-March, right? So,
yeah.
Wrap up with a few final questions here, Strider, and we certainly appreciate your time and your insights. A lot of experts predicted volatility around the election, and we really haven't had any. It's been mostly positive after positive. You mentioned earlier that, obviously stability and clarity coming into the market was a big help. Does, your team and First Trust see more volatility to come, or do we see steady growth? Are we kind of through the woods as far as significant up and down days are concerned?
Yeah, that's a great question, and one that is very hard to answer. I think a lot of the volatility moving forward here will be coming from reactions to how many COVID cases they are, and then with that, reactions that states and municipalities, cities, and counties are making based on that data. And so, if we really start to turn a corner here for the worst and start to shut down everything again, I think that will cause a lot more volatility and will hit the market. I think it's a buying opportunity if that does take place. But I think that's really where the volatility is going to come from moving forward here, in the short term anyway. Volatility is really the price we pay for over time being able to make profit. Mm-hmm. And I think that's what's really important to remember, is that the market in general is very volatile, and that's the price we pay for profits over time. And so if this market stays volatile, we would take advantage of any decline. And the reason I say that is because the outlook for companies right now for corporate profits is still very, very positive. And so we believe over time, higher corporate profits lead to higher stock prices. And so again, we remain very optimistic, very bullish on that.
That kind of led me into my last question to sum everything up we've spoken about today. And again, we certainly appreciate your time. This slide, in fact, is one of my favorites as far as the high frequency data is concerned, because it really shows you people getting back to normal, getting on airplanes again and things of that nature. But, really what we've heard from you today is a positive overall outlook on the markets going forward, with corporate profits continuing to improve, with obviously the stimulus helping everyone out for the short term. First Trust overall is very positive going forward, it sounds like, correct?
Yes, we are very positive. I think when you look out over the next 5 to 10 years with the amount of technology that we have right now at our fingertips, you think about 5G and what that's going to mean for companies being able to connect really thousands of devices in short spans, and be able to take in really trillions of bits of data like never before, where they can make real-time decisions processing through that data with artificial intelligence. I mean, the productivity gains I think we are going to see, not just in the United States, but around the world over the next 5 to 10 years, are going to be like nothing we've ever seen before. And I think not only will profit margins continue to grow through these productivity gains, but profits will continue to hit record highs. And so I think the next 5 to 10 years, despite what's going on with COVID, are going to be some of the best years that we've ever experienced.
Thank you very much for joining us today. Again, if anyone has any specific questions on anything we've covered, please feel free to reach out to me. Again, our website is martinelli-financial.com. My email is mike@martinelli-financial.com. Our phone number here at the office is 610-238-9900. Again, certainly if you have questions from anything Strider and I discussed, would be happy to discuss it with you personally and how it may affect your portfolio. So, Strider, again, thank you so much. And we certainly enjoyed it today. A lot of great insights. And we will talk to you soon down the road. Thank you so much.
Hey, thank you so much, Mike. Take care.
Have a great day.